Today we are going to be covering Chapter 14. Part 1 will be recording the issuance of bonds, interest payments using the straight line and effective rate methods, and adjustment to fair market value. Issuing bonds. We consider issuing bonds. There are some overall issues that you need to make sure you understand. And first, bond is known as a bond indenture. It always includes two cash flows that represent a promise to pay. The first is a sum of money at the end of a designated period, and second, an agreement to make periodic interest at a specified rate on the maturity amount, which is normally stated on the bond. These usually are $1,000 increments, and the interests are normally paid semi-annually, and the dates are specified on the bonds. And they are used by corporations and institutions when they need to raise large amounts of capital and one lender is not capable of providing that amount of money. Now what we're going to look at is the issues associated with bonds. First, determining the cash is always based on the effective or market rate, and usually this is expressed as a percentage of the face. So 105 would be 1.05% of the face, or 97 would be 97% of the face. Also, we need to determine if the bond has been issued at a discount. Usually you can tell this if the cash received is less than the amount owed, or if it has been issued at a premium, the cash received is greater than the amount owed. The other thing we need to look at is cost associated, and what I want to mention here is the new rule that it used to be that any costs, such as the cost of issuing the bond certificates and any legal fees, were treated as an asset on the balance sheet. Well, now instead they are treated as an adjunct account to bonds payable on the balance sheet. Another thing we look at is paying interest. Again, if issued at a discount, then interest expense will be higher than the stated rate, and if a premium, then interest expense will be lower than the amount stated. And then the last thing we cover in part 2 is what happens when we retire the bonds. Now we'll go through a little example, and in this example we'll be looking at, first of all, what happens when we issue bonds. What does it look like when we make our first payment? We accrue our second payment on December 31st, and then what does it look like at year end as the carrying value for the bond. Now, in order to solve this problem, the first thing I always do is identify and write down the pertinent information. If I were you, I would do this too. Write this down because this is going to help you solve the problem. So in this case, the face of the bonds is $600,000 and the stated rate is 10%. These bonds are 20-year and they were issued on January 1st, so we don't have to worry about any partial interest. They were also issued at 102, which means that we received cash of 102% of the face value. Interest is payable semi-annually, and we're using the straight line method. So that's the information we need in order for us to do the journal entries A through C, and then show the carrying value. Now first I want to give you a guide on the order you do the journal entries. This way you have a good chance of getting it correct. First, the cash is always going to be the face of the bond times the percentage stated. So in our case it was 1.02. The bonds payable is always going to be the face of the bonds, or the amount that has to be paid back. And if we have to debit, we have a discount on bonds. And if we have to credit, we have a premium on bonds. Now let's take a look at booking our actual journal entry. We booked $600,000 in bonds and we received 102% of the face. So we know the bonds payable is going to be $600,000. That's what we have to pay back. The cash we received is $600,000 times 1.02, or $612,000. So what we have to do is credit it, which means we have a premium on bond. Also, what that means is that our interest expense is going to be less than the amount we paid. Now we'll do the guide for booking the interest using the straight line method. The first entry you always want to do is the actual cash. That's the easy one. It's the face of the bond times the stated rate on the bond divided by 2 because we have semi-annual interest payments. The second entry we'll make is the amortization of the premium, which is going to be the premium divided by the years of the bond times 2 because we pay semi-annually. And then the plug is always the interest expense, and in this case it's the interest payable minus the premium. Our actual journal entry will look like this. The cash will be $30,000, the premium is going to be $300,000, and the interest expense will be $29,700. Now, whenever you use the straight line method, the entry will always be the same every single time you make an interest payment at the end of 6 months. Now, what happens at year end? Well, we're going to have to accrue the interest. So instead of cash, we're going to use interest payable. We're going to amortize another $300 for our bond, and then we do our interest expense again. Note, this is the same entry. Now, the carrying amount for the bond is going to be the bonds payable plus the premium minus the amounts we've amortized over the last 2 periods, giving us a total of $611,400. Now let's take the same problem, but instead, what does it look like when we make the interest payments and we use the effective rate? And we're going to assume in this case, you need to write that down, our effective rate is going to be 9.7705. Now, when you use the effective rate, you calculate the interest expense by multiplying the effective rate times the net bonds payable, which is the bonds payable minus a discount or plus a premium each time you make a payment. This causes interest expense to be different for each interest payment. Using this method, the amortization of the discount or premium is done last, as shown in our next example. First, I give you a guide for doing the effective rate. Now, in this case, when you use the effective rate, the plug is going to be the amount you show for the premium. So again, the cash is going to be the face of the bond times the stated rate divided by 2. The interest expense is going to be the net bonds payable times the effective rate divided by 2. And the third entry, the plug, is going to be the cash minus interest expense, and that's how much we amortize on the bond. So our first entry, the cash will be 30, just like it was with the straight line method. But interest expense is going to be different because we're going to take the 612 times our effective rate divided by 2, and then the plug is going to be 102. Now we're going to do our accrual at year end. Again, we're going to use interest payable. I'm sorry that number went all the way over there. I don't know why I did that. And our interest expense will be second, and again, the plug is going to be the premium on bond. If you notice, the amount is different now. Now, when we look at the carrying amount, it's going to be the bonds payable plus the premium minus the amount that we've amortized in over the last 2 periods, giving us a carrying amount. If you notice, it's different than when we use the straight line rate. Now, the rule is, under GAAP, they prefer you use the effective rate unless the straight line method gives you similar results. Under the international standard, you must use the effective rate method. Now what I'd like to cover is the effects of adjustments to fair market value. Now, this also has changed recently. Now, the rule is, if the adjustment is based on a change in market rates, then the unrealized gain or loss appears as part of income. If, however, the adjustment to market is based on credit risk, then the adjustment goes to other comprehensive income. So now we're going to take a look at a problem. Here we have a company, and this is what they look like over 3 years. We see the carrying amounts, and then we see the fair value, and we see the change. So if you notice, in year one, there's no entry of unrealized gain or losses because there was no change. In year two, what happened is our carrying value reduced by 5,000. So in this case, we have a gain of 5,000 because we owed less money. Now, for the third year, what has happened is the fair value has gone up. What we need to do is now recover that 5,000 we booked in gains, plus now book that 6,000 in losses, which means we have to end up with booking an $11,000 loss. Now, what does this look like if instead the change was based on the company being risky in terms of their credit ratings? Again, the only difference is that now what's going to happen when you book unrealized holding gain, in this case for 2016, it's going to say equity, and this instead is going to be part of other comprehensive income.